You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, well, we're in the heart of earnings season. Many things are coming out over the next couple of weeks. We are taping Options Playbook Radio on the 23rd. The markets are open, but next week the Options Industry Council seminar is going to be going on in sunny Miami, Florida. So we're going to be taping a little bit early this week around. So right now the markets are open and it's 2 p.m. Eastern time. And we're going to look at a little known stock called Tesla. The symbol is TSLA. They're going to be announcing earnings this week. It's going to be the 24th, a Wednesday, after the close. So the markets are rocking and rolling, and as always on Options Playbook Radio, this is not meant to be a recommendation. But what we're going to look for in Tesla this week is volatility. More than anything, we're just going to be talking about, do you think Tesla will move more than the expected move, or will it move less than the expected move? You can make that call, but this strategy is all centered around what the marketplace is expecting the move to be after earnings. And we're going to take the side that it's going to move more than expected. And then we're going to flip a coin and we're going to say, is it going to go up or is it going to go down? And we're just going to lean it in one direction or the other. So before we get too heavy into it, let's talk about the potential strategies that we can choose. Now, if you want to do the full-blown, I really think it's going to move more than expected, the thing that you do is buy a long straddle. And so let's go in and look at the front month long straddle, since that does tell us the expected move anyways. And a long straddle means that we are buying a long call, we are buying a long put at the same strike, the most at-the-money strike. And most of the time when you're looking at earnings, you're looking at an at-the-money option contract very close to the expiration date. That gives us an idea what the expected move would be also. So the closest expiration date that we have is April 26, which would be this Friday. And that means after earnings, there's going to be 2 full days to trade. There would be all day Thursday, all day Friday. Now, normally, if we're looking at these trades, we're going to look at it on the day of, but we're taping one day before on Options Playbook Radio. So we don't have that ability to look at what the quotes are just before the close of Tesla. But the concept would be the same. You got Tesla trading right now at 263.86. It is up $1.11 on the day. So 263.86 up $1.11 on the day. We're going to say, we'll round that off. We'll call it 264 just for picking our strategies. So stock's around $264. The April 26th long straddle is trading for about $22. Now, remember, whenever we look at expected move, there's no regard to direction. What the marketplace is just implying is that it's very feasible for Tesla to trade $22 higher or $22 lower. That's not an issue. So as far as Tesla is concerned, that's the range. That's the range. As far as the marketplace is concerned, that's the range. Now, another way I always like to look at it is that's really the over-under as far as the marketplace is considering. That's if you think it's going to move more than that, you're taking the over. If you think it's going to move less than that, you're taking the under. And so in this instance, we're going to do the over. So what's a trade that we can do based off of that long straddle? I don't necessarily want to put out that premium, $22, $2,200 for one long straddle. So what could we do that if our forecast is correct, we can make money in either direction without having to put that much capital up front and have all that time decay scenario? Well, one of the things that we can do is called a back spread. And in this instance, we flipped our coin and we're going to be a little bit bearish. So what a back spread is you're going to sell an in-the-money put option and you're going to buy two at-the-money put options. So you're selling an expensive option contract and we're going to try to pay for two at-the-money, less expensive option contracts. That's the whole concept of a back spread. So we're going to be selling one option and buying two options. That means net to the downside, we're going to be long one extra put option. And that's the workhorse here. We're hoping that if the market does go down and it goes down a lot, that the fact that we're long two puts and short one put means that we have a substantial upside potential if the market goes way beyond what the expected move is to the downside. All right. Now, with that said, we're selling an expensive option contract in general, and we want to get it done for a net credit to the account. And if we do that, that means that if we're dead wrong and the market goes on up and it goes against us in this instance, because we want to be bearish, and it goes to the bull side and it moves more than the expected move on the upside, well, then we'll receive a net credit and all the options would expire worthless. And in that instance, we make the net credit to the account. Wow, sounds too good to be true, right? Well, where's the downside? Well, the downside would be if the stock didn't move at all. The stock stayed right where it was at. The maximum loss on the trade would be the width of the spread, which is going to be approximately what the expected move is. Some people will call this a pay later put because of that, because we're not paying for this trade up front. We'd have to pay later if we are dead wrong. But the max loss only occurs right at the long strike that you're buying, and it really only occurs right at expiration. So if we can buy time, that actually gives us even a better buffer, if you will, on the entire trade. So the first trade, and then we're going to look at a derivative of it. So let's look at this back spread with puts. So in our instance, as I mentioned, I'm trying to freeze the quotes on Tesla, so I've just basically unplugged the internet. So we're 264 is going to be our number, 264. It's up $1 and change today at this point in time. What we would look to do is we're going to go out to the May expiration. We're not going to do the April because we're going to give ourselves a little bit of buffer. And even after earnings, Tesla options are going to have a lot of premium in it. So an extra week of time is definitely a benefit. We're going to buy the May 3rd expiration date. So we're going to go out 10 days. We're going to go a little bit in the money. We're going to go about the expected move in the money because that's what we have to do in order to get this done for a net credit, which is the ultimate goal. So we're going to sell the 285 strike put with the stock at 264. And then we're going to use that capital to buy two of the at the money puts. We're going to go just a little bit out of the money. We're going to buy the 262.50 puts. So we are selling the 285 put. We're buying two of the 262 puts on the May 3rd expiration, about 10 days away, and we can get this done for a net credit of $1.13 to the account. The expected move on the shortest expiration is 22 points. On the expiration that we chose is about 26 points. So 285 minus 262.50, that's 22.50. So it's kind of weird how we can get this trade done as long as we go about 22 points in the money, which is approximately the expected move on the short-term option contracts. So it's really a play, like I said. Do you think it will move more? If it moves more to the downside, that's wonderful. If it moves more to the upside, well, that's okay. We got it done for a small credit. And we're going to react as soon as the earnings are announced. So if we get the big, in this instance, we do want a big gap opening, hopefully to the downside, but we'll take one to the upside. All right. So because we have 22.5 points of risk, that's also going to be the margin requirement. So $2,250 would be the margin that we needed on this trade. Now, remember, for us to lose that entire amount, that's our maximum risk, but the stock would have to stop right at 262.50. All right. So to recap, a back spread with puts on Tesla. The market is open right now on Tuesday, the 23rd of April. Right now it's about 2 o'clock, but we've froze the market at 264. We're looking to sell one Tesla May 3rd expiration, 285 put, and then use the proceeds from that one option contract to buy two of the Tesla May 3rd, 262 put. Right now, the midpoint is at $1.13 net credit to the account. The maximum loss in this scenario would be the 22.50, the width of the spread, minus the $1.13, assuming that we could get a fill at the midpoint. And obviously, don't forget commissions. So the maximum that we could lose if we're extremely unlucky would be 21.37, but it is always feasible and worth noting. And as always on Options Playbook Radio, these are not meant to be recommendations. So we talked about the long straddle. We talked about the put back spread. Now there's one other thing that we can do. We're still talking about $2,137 worth of risk for every 1/2 back spread that we did. Now, the next thing is we can actually turn this into an inverse skip strike. In other words, if you don't think the market's going to just completely tank and you want to have unlimited upside or substantial upside as the market goes down, you can look at doing selling another option contract just further down. So going down about 30, well, in this instance, let's go down 30 points in that same expiration. They'll give us a little bit more upside as the market goes down. Remember, we're the distance between the one that we sold and the one that we bought was 22.50. So now we're going to go down about 30 points. So in order to figure out what option contract we want to sell in the May 3rd expiration, you take 265 minus the 30 points that we were mentioning. So we're going to look at 235 on the downside. And now if we sell that option contract, we're going to bring in another $1.90 to the account at the midpoint. So now if we're dead wrong and the market goes up the expected move or more, we're going to bring in more of a credit. So by doing this, we're giving ourselves more upside if we're dead wrong on our forecast. So in this instance, we were looking at $1.13 midpoint on our back spread, but we're going to bring in $1.90 by selling the 235 strike put. So $1.90 plus $1.13 means the net credit is, we'll call it $3, $3.03 to be exact, but we'll call it $3 in this situation. So what does that do to our trade? Well, it protects us a little bit more because we got another $1.90 to help reduce our risk and help pay for our margin requirement. But it also reduces our upside on the entire trade. If the market goes down below 235, that extra long put that we have just won't help us out as much anymore. So if we do sell that 235 strike put, it limits the maximum upside that we can make on this trade. But it also helps if we're dead wrong. If the market goes on up, it helps in that scenario too. So we have 3 different trades to look at. The long straddle means that you're buying a lot of premium and you really need to make sure that you think this market's going to move more than the expected move. The back spread will give you a lot of upside, much like the long straddle will if you are correct on your forecast, but it's only going to do it in one direction. And in our instance, we picked puts this week just because we flipped the coin and puts came up. And the last one is the inverse skip strike. That's the most conservative of all of them. They're all fairly risky overall because we're doing them around early earnings on an extremely volatile stock. But with that said, we're going to bring in more of a net credit. It gives us more upside if we are wrong and the market goes to the upside. Gives us a little bit more of a buffer if it stays in between the strikes. And it limits our maximum upside potential if we are correct and the market does go down. That's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.